In this video, I'm going to show you how you can use the stock market like a high interest savings account. My name is Dean the Wealth Coach and welcome. Many people think that the stock market is a risky and unpredictable environment. If used correctly, it can help you grow your wealth over a long period of time. So the first thing that you want to do is you want to set your investment goals and create a plan around it, because to fail to plan is to plan to fail. So before you start investing your money, you should start by taking a risk tolerance test. How do you figure out your risk tolerances? You can go to a financial advisor, you can Google it. There's a lot of online risk assessments that you can take. So that's the first thing you want to do. Once you understand what your risk appetite is, then you can create a plan around that of the type of investments that you'll be making. The next thing that you want to do is diversify your portfolio. Investing in a diversified portfolio of stocks is key to achieving long-term growth. A diversified portfolio includes stocks of various industries, sectors, as well as different sized companies. This will help you reduce your risk by spreading your investments across multiple companies and industries. So say you have something in tech and in healthcare. If tech is not doing good, but healthcare is, it will balance out each other. Whereas if you had one stock and it wasn't doing well, then boom, there goes your money. Hold your investments for the long term. Investing in the stock market requires patience. Patience is key. Patience pays. While the stock market can be volatile in the short term, it tends to have an uptrend over a long period of time. So this means it's important to hold your investments long term, even if the market is experiencing short term dips. Look at the history of the stock market. It goes down and then it comes back up. The more that you're willing to hold a stock for the long term, the better the payoff will be. If you're just going in for like a one-day gain, thinking that like, oh, I need to build my savings up in like a week or in a day, you're not really going to see the type of returns that you want to see. Whereas someone that's been saving for like 2-3 years, you would see that growth over like a 1 to 3 year period. If you're finding value in this video, don't forget to subscribe to my channel. Next is reinvest your dividends. Many stocks pay dividends, which is a portion of the company's profits paid out to shareholders. By reinvesting your dividends, you can buy more shares of the stocks, which can help grow your investment over time. This is known as compounding. If you're unsure of what compounding is, I made a video up above talking about compound interest. The longer you compound your investment, the larger your return will be over time. So I want to show you guys this here. This is what high interest savings accounts are paying in Canada, or a few of them, okay? Look at this. Let me move my face out the way. Look at that, 4%, 3%. And I'm pretty sure this 4% is like a promotional rate. 3%. Let's look at the big banks. The big banks, look at this, BMO 1%. RBC 1.5, 1.5. So literally this is what you're making on your money. Now you let me know, does this seem like it's even worth it? Let's go look at the stock market. Let's see what the stock market's paying. So we're not looking for the short term. However, but short term, look, down, not even 1% you're down if you're invested in the stock market as your savings account. So after 3 months you make about, or after a month, up thing. But this is in real time. So we're not gonna really focus on the 1 month growth or the 3 month. 52 weeks, you're down about 6%. So, okay, so the banks would be beating us right now. However, let's focus on the 2 year plus, how much this has grown. So in 2 years, about 3.79%, which is a bit better than the banks. Look at this, 3 years, 22%. Banks are not giving you that. Banks are nowhere near giving you that much interest on your money. Now look at this 5-year growth. If you just had money sitting there for 5 years, say you're looking to purchase a house, your vehicle, pay for school, whatever it may be. Look at this, in 5 years, 48%. 10 years, you're saving for retirement, 168%. 20 years, 379%. Do you see the difference between investing in a high interest savings account versus using the stock market? Crazy, right? Now you want to keep an eye on your investments. And I don't mean like every day go check the stock market. It's like, hey, how's my stock doing? No, like every quarter or once a year, I make the necessary adjustments to make sure that everything's in balance. This includes selling stocks that are no longer performing well or adding new stocks to your portfolio. Another thing that you can do is you can get a robo advisor or a financial advisor. A robo-advisor just uses algorithms to make financial decisions for you, and there's no human interaction. Financial planner sits down with you, goes through everything, how much you make, how much you saved, your goals, and pretty much creates a plan for you. So that's another avenue that you can visit as well. Be prepared for market volatility. So what is market volatility? Market volatility is how the stock price is moving up and down. So just it's important to be prepared for market fluctuations. This means having a diverse portfolio, holding your investments for the long term, and not making emotional decisions based on short-term market movements. Market crash is not always a bad thing, because if the market crashes and you say you purchase something at $100 and now it's $50, now what you can do is you can average down by buying at $50. So now if you have one share at $100 and you buy one for $50, the average of the two is $75, which puts you at a better entry point. So now if it does hit $100, you'll be up $50 opposed to just breaking even. So don't always look at a market crash as a bad thing. It could be a good thing. If you did buy something at a high price, now you can average down to get a better price. To recap everything in this video, you want to make sure that you set your goals and create a plan, and also find out what your risk appetite is by doing a risk assessment test. Then you want to diversify your portfolio. Don't put all your eggs in one basket. Then you want to make sure that you hold for the long term. I showed you the growth over the long period of time, how much money you can make versus a regular savings account. So you be the judge. Then reinvest your dividends. Depending on what you invest in, you could get every quarter, every month, semi-annually. It all depends on the stock that you purchase, right? Adjust your portfolio as needed every so often. I would say anywhere from 6 months to a year. Just reevaluate your stock portfolio. Be prepared for market volatility. Things do move up and down. News comes out. Many different things, the economy. If you found value in this video, don't forget to hit the like button and subscribe to my channel. And if you want to get a free copy of my stock market blueprint guide, click the link below to join my mailing list to get your copy today. I've also linked a video for you to watch next on how to get started in the stock market.